Alrighty. So in today's video, I'm going to be talking about stock selection for the wheel strategy. So a quick recap on what the wheel strategy is in case this is the first time that you've exposed to this term, the wheel strategy. I've also created a number of videos on the wheel strategy. You can click the playlist at the top right hand corner of this video so you can go ahead and watch that at your own time. But for the wheel strategy, basically how it starts off is by selling a cash secured put with the goal of getting assigned 100 shares. So for example, the stock may be doing this right now. Then let's say you want to get into a wheel strategy position. What you want to do is you will sell a cash secured put below where the current price is of the stock. So if the market closes below your strike price of your cash secured put expiration, what will happen is that you will get assigned and you will be long 100 shares. So this is where you will get 100 shares. Now the next step is to sell a covered call. So when you sell a covered call, again, you get premium. So selling the covered call, you can either choose to sell at the same place, right, at the same strike price where you are long 100 shares, or you could choose to place the covered call above it. So this way, if the market does close above the covered call at expiration, what will happen is that your 100 shares will be called away, and then you will get the profit in terms of the difference between where your shares got called away and where you entered, right? So there are three ways you can get an income from the wheel strategy. First, from the cash secured put, from the covered call, and also from the capital gains of your stock. Now, some people choose to place the covered call at the same level, which they are long 100 shares, which is perfectly fine as well. So in this case, what you'll be doing is that you'll be just getting the premium from the cash secured put and the covered call. So basically, this is the wheel strategy in a nutshell, and the whole idea here is to just do this all over again, over and over again. That's why it's called the wheel strategy. Now, next is the stock selection strategy. Now, for the wheel strategy, selecting the right stocks plays a very big part, right? It plays a very big part in the success of the overall strategy, especially right now where the market is crashing. So, for example, if you get assigned on your cash secured put and you become long 100 shares and the market subsequently crashes, well, it may never go back up to your entry point, right? Depending on the kind of stocks that you choose. So when the market crashes, though everything just drops, right? No matter what kind of stocks that you're holding, any kind of equity you're holding, is just going to drop quite a big amount. So as you can see, a number of stocks right now have really crashed even up to 70%. So if you had your cash secured put somewhere up where the market kind of peaked, right? For example, if you sold your cash secured put somewhere down here, and then the market after that has crashed significantly much below your entry point, what happens right now is that you are stuck with 100 shares and you may face the problem where you're not able to sell a covered call at the entry price or above your entry price, right? So the only other thing that you might be tempted to do is to sell a covered call below your entry price, maybe somewhere here. And while you can do that, the risk is that if the market was to suddenly rally on some kind of a news which the market perceives as very positive, it may become very difficult for you to roll the covered call up and you could be locking yourself in a loss, right? So this will be the loss which you'll be taking if you cannot roll your covered call and the market actually expires, outside above your cover call at expiration. So that is the risk that we always have when we are doing the wheel strategy. So that is why when you're selecting stocks for the wheel strategy is very important. You have to choose the kind of stocks that in the long term at least it will still go back up. So while we want to have high volatility, right, to get the high premiums from selling our cash secured put and cover call, you also want to choose stocks that will go up in the long term. So especially right now where the market is crashing, you want to ensure that you have a stock that, even though if you are long at this price down here, in the end, if the stock eventually does go back up higher, you can still get out of this position rather than you're stuck with a stock that may not necessarily go back up. So when it comes to wheel strategy, there are two methods that people usually use, right? The first method is the most common one, which is basically focus on, purely on extrinsic value gains, right? They just want to go for the stocks with the highest volatility. This way they can sell the cash secured put and the cover call with a lot of premium, right? They get a lot of premium, but these stocks may not necessarily be fundamentally good stocks, right? They may not necessarily go up in the long term. Now, the next method is to be focused more on intrinsic value and moderately high extrinsic value gains. And I say moderately high extrinsic value gain is because it is considered high, but not necessarily as high as stocks where it's focused purely on extrinsic value gains. So what I want to do is I want to get into details on both of the methods so you can decide for yourself which you think is better for you. So for the first method, this is focused purely on extrinsic value gain. So you are only looking for stocks purely based on high volatility, right? All you have to do is just search for stocks that gives you very high volatility. So as you can see, these are your meme stocks like your AMC and your GameStops. And this is AMC option chain. As you can see down here, the volatility is pretty high. I mean, the premiums that they give will be pretty high because your volatility is quite high. You can see they are in the hundreds of percent, right? 198%, 300%, 200%. So this is considered pretty high. That is why you can get pretty juicy premiums. But the problem with such kind of stocks is that it can have very big wild swings, right? As you can see, the stock has gone from somewhere around like what, $2, it shot up to around $44, and now it has gone all the way back down to $6, right? So if you were to somehow sell a cash secured put, maybe let's say roughly around $32 at this point in time, then it becomes a little bit uncertain whether the stock is going to go back up, right? We never know, is it going to go back up or is it going to continue going back down? So when you choose this kind of stocks, although you're going to get very high premium, right? You get high volatility, that's why you get high premium, but we're unsure whether you can actually get back to your entry price if somehow you get assigned right before the market really crashes. So for this kind of stocks, you do need to have very strong chart reading and market timing skills, because if you time it at a place where the market subsequently collapses, then you're going to get worried because you're not sure whether the market is going to go back up. Now, one of the factors to determine whether the stock will actually go up in the long term is whether it has strong fundamentals. So strong fundamentals basically just mean whether the company is profitable in the long term, right? Has it been profitable before? Has it been consistently been growing its revenue and its profits? So if you were to take a look at AMC's income statement, you can see that the revenues and income is pretty much all over the place, right? So you can see that in 2017 to 2019, right, you have pretty flat revenue. After that, it has a drop, then it increases. But in terms of the income, as you can see in this yellow color, the profitability is all over the place, right? You lose money here, you're slightly positive over here, but then you're negative here, and then you start to lose money in 2020. 2021, you're also still losing money. So this becomes a little bit of a question mark whether this market, or rather this stock, will sustain, right? Will it still be around the next 5 years in case, let's say, the stock just dwindles around the price right now of $6, right? If it stays around here, $6 for the next 5 years, we don't even know whether this stock is going to go back up to your entry price. So it becomes very uncertain. Now, that is not to say that it may not become profitable in the long term. Of course, there is a chance, right? If AMC changes the business model or AMC becomes profitable in the long term, then the stock can eventually go up. But as of right now, it is a big question mark, right? Because as of this moment, it is still unprofitable. So that's why the future of this stock is uncertain. So while you may have very high premiums from selling all the cash secured put and the covered call, you may get into a situation whereby, you know, like right now when the market is crashing, you're stuck with a position and you are very uncertain whether the market is going to go back to your entry price. By the way, if this video has been helpful for you so far, I'd appreciate it if you just give me a thumbs up and also subscribe to my channel so I can create more videos like this for you in the future. Alright, back to the video. Alright, so method number 2 is to be more focused on intrinsic value and moderately high extrinsic value gain. So this is the method which I tend to use because I know that my market timing is not that good. I might get into a stock where the market, you know, maybe I sold a cash secured put here and then the market starts to crash, right? And if the market crash, I want to have this room for error, which I have, right, for the stocks, that it will eventually still go back up. And the only way for it to go back up is that if the stock has good fundamentals. So this is, as you can see, is the stock of Apple. Apple is one of those stocks where I think it has good fundamentals and it will always go higher in the long term because so far it has done so for the past many decades, right? So now in terms of the volatility, as you can see, it's not as high as AMC. All right, it's only about 49 point something percent, but it's actually still pretty decent. right now the market is crashing, so there's quite a little bit of volatility in the market, so that is why this can be also a very good candidate for the wheel strategy. So for this method to focus on intrinsic value and moderately high extrinsic value gains, there are three criteria that you want to look out for. So first, you want to have good fundamentals. So good fundamentals, basically there's increasing revenue, increasing profits, and generally we want the assets to be more than the liabilities, right? If the liabilities is more than the assets, then there's a chance the company can go bankrupt. Now, criteria number two is strong technicals. That means to say the company has been around for several market crashes, and every time after a crash, it still continued to make new highs. So this way we know that they are pretty resilient, right? We know that if they have survived number of crashes before, if they've survived like 2, 3, 4 crashes before, we know that right now in the current market situation, if the market crash, there's also still a good probability, a good chance that the market can recover in the long term. And also we want a moderately high volatility, right? So this is where you want to choose tech stocks instead of consumer staples. And I know right now tech stocks have been beaten very badly because the Fed has been increasing the interest rates non-stop, trying to control inflation, which is also why the tech stocks have, pretty high volatility compared to other kinds of stocks, the consumer staples, right? So I want to get into a few examples. So a few examples, it would be Apple. So as mentioned before, Apple is a fundamentally good stock. So as you can see, as of now, the lowest that it has gone to is negative 29%, right? It has crashed roughly 29%, but it has recovered slightly and starting to go down. So right now from here, we have no idea what is it going to do. Is it going to go up? Is it going to continue to crash? We never know, right? So there's definitely more downside to go if it continues to crash. But what's important to understand is that it is a profitable stock. So as you can see, this is the income statement for Apple. Now, this is a huge contrast to the one you saw on AMC, right? So for Apple, you can see that the revenue is generally increasing over the long term and it has been profitable every single year. You can take a look at the net income. Again, the net income is also profitable every single year and it's also slowly, gradually increasing. So we know that Apple, at least in the long term, if you get caught in a position where the market has crashed from where your entry price is, at least we know that in a number of years time it will still go back up, right? It has a good chance of going back up rather than you being uncertain about it. So let's take a look at the past. So Apple is no stranger to crashes. So as you can see in the past, it has crashed quite a number of times. You can see that in 2008, right, although it looks like a very small retracement here, that's only because Apple has really gone up right after that, right? So, but during that, back then, 2008 was the financial crisis, everything crashed, right? So it crashed 61%, but in the end, it still made higher highs, right? It survived the crash, it became stronger. After that, it crashed again, right? 45% crash, but then it made new highs again. And this time it crashed 34%, but then it made new highs again. So at the current point where it stands, the lowest it has crashed is 29%. So there definitely is a chance that it may crash, right, to as low as 61% in the past. Right now, of course, it may not necessarily definitely crash. Who knows what the market is going to do? No one knows, right? But we do know is that even though if you get caught right at the high, right, at least you're not going to lose that money if you just hold on to it, right? That is also one of the reasons why when I enter into a wheel strategy, I don't just have one entry, right? I don't just have one cash secured put and then, I just leave it there until they get assigned and then I just sell a cover call. Instead, I try to have many levels. I plan out to have many levels just in case the market crashes. And I talk about this in another video as well. All right, the next example will be Google. Again, Google is another tech stock. Again, you can see that it has been taking a beating as well. It is down 36%. But the good news is that Google is also a fundamentally good stock. As you can see, increasing revenue, increasing profits as well. And Google, like Apple, is no stranger to crashes. If you take a look at 2008, it has crashed 67%. But the important thing to understand is that the market has survived the crash, right? Google has emerged stronger even after it has such a huge drawdown on the stock. It became stronger only because Google is profitable. Now the last stock is Microsoft. Now Microsoft right now also has taken a beating, right? It's down 33%, but Microsoft as well is a profitable company. Again, you can see it has very strong income statement. It's a very strong fundamentals. You can see that the revenue is increasing year after year. the income is also increasing year after year. That is why even though there are crashes, Microsoft will still recover, right? So as you can see, in 2000 all the way to 2009, it has the biggest crash ever, and this lasted almost a decade, even longer than a decade, for it to finally come back up to the highest point. So even though if for some reason you manage to get yourself into a cash secure put position, you assign yourself 100 shares down here, right? Your money isn't lost. It's just that, you know, you lose out on the opportunity cost of making all this money during this time, but then you still get your money back at the end of, right, 17 years. But the thing is that the market, although has crashed 75%, right, Microsoft has gone down 75% from its high, it still manages to make a new high eventually. And then you can see back then it was like $84. It's already considered so high. But if you take a look at the stock right now, it's about $237. Even went to a high of $340. So that is why when it comes to the wheel strategy, you want to be quite smart when you choose the stocks that you want to do it, right? So if you want to go more for high premiums, you can definitely do that. But do keep in mind that you do need to be pretty right on your entry price, right? You need to be good at your market timing, because if the market is to crash, you're going to be uncertain, right? You're not sure it's going to go back up. But if you go for stocks like Microsoft, these are all fundamentally strong and good companies. You know that although your market timing is not good, you still have room for error, because in the long term, it can come back up, right? So you can take it as though it is an investment. So again, there are many ways to make the wheels safer, the wheel strategy safer, and the way that I like to do it is, again, to split it into many different levels, right? Wait until the market is oversold, then you start your first level, your second level, your third level, your fourth level. Basically, you want to space them out by percentage or by dollar terms, and basically you just have more chance of making it work rather than you have just one. So this way, if the market crashes, right, you can still have the other levels to generate more income for you. And again, I explain all this in all my other videos. So alright guys, that's it for this video. I hope this video has been helpful for you, and if it has, I appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching, appreciate your time, and may the options favor you.